Hello, everyone. Ken Tumolo, and welcome to this month's Tumolo Talk. This month's Tumolo Talk, I'm going to talk about annuities. And the big reason I want to do that is just to give people an idea about them. It's you hear good, you hear bad. One advisor will tell you it's great, one will tell you it's no good. The best answer is it depends. It really depends on your situation. Why did you buy that annuity? Does it fix a problem? And what I mean by that, I'll use the old analogy that everyone likes to use. If you have to put a hole in a wall, there's two ways to go about it. One, you take a hammer and you slam a hole in the wall, and it's just a mess. The better option is you go and you get a drill and you drill the hole so it's nice and round and it looks good and it's actually what you need. So really, a couple ways to do things. It's using the right tools. So annuities, and I'm going to keep it basic today. Mainly three types that we run into out there. One is the fixed annuity. Think CD, but it is not a CD. And CDs are a bank product, certain protections for CDs. But the thing with it, it's the idea of one in theory because you give a company money. They keep your money for a certain amount of time, let's say 3, 5, 7 years, and they give you a set amount of interest each year. And then at the end of your term, you just take your money back with all the interest. So that's why I say it's like a CD. You give the bank money. They basically set a term, let's say 3 years. They give you a set amount of interest for 3 years. End of the term, you take your money back or you just renew. So it's simple, easy, just a way to make money on your money without, taking the risk of the market. Other type of annuity, variable annuity. And I feel these are the most, well, sometimes the most complicated of everything. The fixed annuity, easy to explain. The variable annuity, sub accounts that move up and down with the market, sub accounts that will basically just earn interest. Then a lot of times income riders, and then when you dig into it, a bunch of fees. Not saying that they're bad. Sometimes the fee is worth it because you're getting something in return. A lot of times it's like an income rider that would pay you for life. So this way you even if you ran out of money, you still get a payment. So there is a use for them. Over the years, the next type of annuity became more and more popular. The fixed index annuity actually has become very popular as a retirement tool because you could use it multiple ways. One, you put money in there and you can earn a fixed amount on some of the money or all of the money. And then you could also index, they call it their indexing option. So if the market has a good year, you make money. If the market has a bad year and it goes down, you don't lose any money. So it's builds protections in. Plus, you could do those income riders if you wanted to. A trick, though, I will tell you with those, unless you absolutely need one of those income riders, you don't want to put it on because it holds back your gains. But I'm going to discuss that a little bit in the next slide. Um, Types of payout. When you structure these annuities, some people will use them to pay monthly, sort of like what a pension does. You work your whole life and then it pays you and then a pension pays you monthly until you pass away. And you could even add beneficiaries to that too. So think of these annuities, they try to emulate that. There's the deferred annuity where you put money in, grows over a period of time, and then you start to drop monthly and it'll pay you till you die, even if it runs out of money. So if you live a long time, it's a way of stretching your money out if you didn't quite save enough, is the way that I would put it. Immediate annuities work kind of the same way, except you start getting paid right away day one, and it'll pay you till you pass away. There's very little gain in those. It's just more of a payout tool. Uh, and then some of these annuities have what they call income riders, where they will pay a period of time. You could stop them if you need to, and you still have the flexibility of pulling extra money out of the annuity, but it actually knocks down the amount that would pay monthly to you. So they started to make these things a lot more flexible. The most flexible way that we like to use it, when we use these, and if we looked at all the annuities across the board. The majority of the way that we set it up is you set them up for kind of growth. So those fixed index annuities, when we set them up, we don't put income riders on it. So we do that so we don't hold back the growth. And we use it more of a backup to the market. So if the market were to go down, then clients can pull up to 10% out of the annuity per year. So yeah, you can take a large chunk out of them. You can make them run out of money doing it that way. But it gives someone the most flexibility with their own money. Other than that, it's really using the proper tool So, depending on your situation, an annuity might be right for you. It might not be right for you. I will tell you, in retirement, in the way that I've built plans, or our team has built plans over the years, there's more than one way to do things. So, there are other things other than annuities, but for some people, it is the right tool. So, sort of going back to that same analogy, to put a hole in the wall, do you need a hammer or do you need a drill? Do you want it to look good or look bad? So, it's got to be the proper tool. So, all starts with that retirement checkup, running those projections, seeing where you stand, and then matching up the proper tools to your plan. It's retirement. It's your retirement. We want you to enjoy it. We also don't want you to worry too much about the market. So if things do go bad in the market, we still want you to live your life. We don't want you to put those retirement dreams on hold. Our number, 860-650-3005, or visit us at tfcheckup.com.